The next crash will not look like 2008. That is the first uncomfortable truth most people are still trying to ignore. 2008 was violent, but it was also cushioned. This time, the ground underneath the economy is thinner, the shock absorbers are worn out, and the bill is much larger. Today, American household debt has surpassed $18 trillion. Wages for the average worker have failed to keep pace with the cost of housing for more than a decade. The result is an economy that appears to be moving forward, but only because it is being pushed by borrowing rather than income. At the same time, the world's largest economy is flirting with a basic failure of governance. The United States government has repeatedly faced shutdowns because it cannot agree on how to fund itself. Federal workers sent home without pay have become a recurring headline, no longer a national emergency, but a political routine. That alone should raise alarms. When the system that prints the world's reserve currency struggles to pay its own staff, confidence quietly erodes long before markets react. What makes this moment more dangerous than 2008 is not just the size of the debt, but who is carrying it. Households are leaning on credit cards to bridge everyday expenses. Businesses that survived the last crisis by refinancing cheap debt are now confronting higher interest costs and slowing demand. In recent months, corporate bankruptcies have climbed to levels not seen since the aftermath of the last financial crisis, signaling that the weakest firms are already breaking under the strain. This is not a future problem. It is happening now, just without the drama of a market crash yet. There is also a growing disconnect between official economic optimism and lived reality. Stock indices remain elevated, driven by a narrow group of technology companies, while large segments of the workforce feel stuck. Recent surveys of major employers show that a growing number of companies are preparing workforce reductions in the coming year, citing weak demand and persistent cost pressures. These are not panic reactions, they are preemptive moves. The pattern is familiar. In the late 1920s, debt expanded faster than incomes. In the mid-2000s, credit growth masked structural weakness. Each time, the crash arrived not as a surprise, but as the inevitable end of a long illusion. The uncomfortable conclusion is that the United States has rebuilt the same structure again, only larger and more fragile. The question is no longer whether the system will crack, but how much damage will be done when it does. The most persistent myth surrounding economic crises is that government debt is the primary villain. It sounds intuitive, it fits political talking points, and it offers a convenient target. But history tells a different story. The real accelerant of financial collapse has almost always been private debt. In the late 1920s, government debt was relatively modest. What exploded instead was borrowing by households and businesses. By 1929, private debt in the United States had climbed to roughly 120% of gross domestic product. When incomes faltered, that leverage turned from fuel into a weapon. The same pattern repeated before the financial crisis of 2008. In the years leading up to the crash, private debt surged to around 160% of gross domestic product, driven largely by housing speculation and easy credit. Government debt was not the problem then either. It was the cleanup crew. The collapse came when households could no longer refinance, when asset prices stopped rising, and when lenders abruptly pulled back. Today, the structure looks disturbingly familiar. Private debt once again dwarfs historical norms, even though it has retreated slightly from its peak after the last crisis. The difference is that this time, the economy never truly healed. After the Great Depression, private debt fell by roughly 65% over 15 years, clearing the slate for a genuine recovery. After 2008, private debt declined by only about 15% over a similar period. The system never reset. It simply paused. That incomplete deleveraging matters. High private debt makes an economy fragile because it depends on continuous credit expansion to sustain demand. When borrowing slows, spending slows. When spending slows, incomes fall. And when incomes fall, debt burdens become heavier, not lighter. This is the trap policymakers keep stepping into. Recent data show that growth in consumer credit and business lending has begun to stall, even as debt levels remain elevated. Delinquencies on credit cards and small business loans are rising, particularly among lower-income households and highly leveraged firms. These are early warning signals, not isolated incidents. They suggest that the credit engine is losing momentum at exactly the wrong moment. The danger is not that government debt is high. Governments can tax, spend, and refinance over long horizons. The danger is that millions of households and businesses cannot. When private debt reaches a point where it no longer supports growth but instead suppresses it, the economy becomes brittle. That is when small shocks turn into systemic failures. And that is why focusing on private debt is not academic nitpicking. It is the difference between understanding the next crash and being blindsided by it again. To understand why the next downturn could be so destructive, you have to understand one mechanism that is still widely misunderstood. Credit is not neutral. In the real economy, banks do not simply move money from savers to borrowers. They create money when they lend. When a bank extends a loan, it simultaneously creates a deposit. That new money enters the economy because people do not borrow for the pleasure of being in debt. They borrow to spend. As long as credit is expanding, this process boosts aggregate demand and aggregate income. Growth looks strong, unemployment stays low, and asset prices rise. This is exactly what happened in the 1920s and again in the early 2000s. In both periods, credit growth masked structural weakness. The illusion of prosperity held until it did not. The collapse begins when credit stops growing. The change in debt, not the level of debt, is what drives economic momentum. Before the financial crisis of 2008, credit-based demand in the United States was running at roughly plus 15% of gross domestic product. By 2009, it had swung to around minus 5%. That reversal was catastrophic. Spending collapsed, unemployment surged, and the economy entered free fall. Nothing magical happened in those months. The credit engine simply went into reverse. What makes the current situation more dangerous is how little room there is for error. Credit growth today is already weak compared to previous expansions. Households are stretched. Businesses are cautious. Banks, facing tighter regulations and higher risk, are less willing to lend aggressively. Recent figures show that growth in consumer lending has slowed sharply, while defaults on credit cards and auto loans have begun to rise, particularly among lower-income borrowers. This is what a credit cycle looks like just before it turns. The data leave little room for debate. When the annual change in private debt is compared to the unemployment rate, the correlation is extraordinarily strong. As credit rises, unemployment falls. When credit contracts, unemployment spikes. This is not theory. It is an empirical pattern that has repeated across decades. Economists would kill for correlations this consistent in any other field, yet many still dismiss them as inconvenient. The problem is timing. Credit does not collapse overnight. It weakens quietly, quarter by quarter, until a trigger appears. That trigger could be higher interest rates, falling asset prices, or a sudden loss of confidence. Once it hits, the feedback loop is brutal. Falling credit reduces spending. Reduced spending cuts incomes. Lower incomes increase defaults. Defaults make banks pull back even further. By the time the damage is visible in headline numbers, the system is already deep into the downturn. This is why the next crash will not announce itself with a single dramatic event. It will emerge from a slow suffocation of credit. And by the time most people realize what is happening, the economy will already be sliding downhill with very little traction left. If the mechanics of credit are so central to booms and busts, the obvious question is why the warning signs are repeatedly ignored. The answer lies in a long-standing intellectual blind spot. Mainstream economic thinking has spent decades treating the banking system as a passive middleman rather than an active force. In that framework, banks merely connect savers with borrowers. Debt is just a transfer. If one person spends less, another spends more. Nothing truly changes at the macro level. It is a neat story. It is also dangerously wrong. This mistake is not new. In the aftermath of the 1929 crash, the economist Irving Fisher identified what he called debt deflation as the core driver of the Great Depression. Excessive private debt, followed by falling prices and collapsing incomes, created a vicious spiral that markets alone could not correct. Fisher later admitted his own failure to see the crash coming because he had assumed the economy naturally gravitated toward equilibrium. Reality, he concluded, was anything but stable. Yet that lesson was gradually buried. Modern economic models returned to equilibrium thinking and quietly removed banks, private debt, and money creation from their core assumptions. In those models, changes in private debt are treated as largely irrelevant to overall economic activity. That belief shaped policy before 2008, and it shapes policy again today. When warnings about credit bubbles surface, they are often dismissed as alarmist or outside the consensus. The irony is hard to miss. Policymakers praise themselves for having learned from the last crisis, yet the same conceptual errors remain in place. Recent international assessments acknowledge that financial system vulnerabilities remain elevated despite stable headline indicators, particularly due to high leverage, asset price inflation, and growing exposure to private credit markets. In plain English, the risks are visible, but the models still underestimate their impact. This disconnect explains why crises are always labeled unexpected. They are unexpected only within frameworks that assume stability. When those assumptions break, reality looks like chaos. When credit collapses, the models say demand should hold. It does not. When banks pull back, the theory says spending should reallocate. It vanishes instead. The result is a profession that consistently misreads turning points. The warnings are there, but they come from outside the mainstream and are treated as heretical until it is too late. By the time the consensus changes its mind, the damage has already spread through jobs, incomes, and balance sheets. That is not a failure of data, it is a failure of imagination. And it is precisely why the next crash is likely to catch so many people off guard once again. If the last crisis was hard to contain, the next one may be harder still, because many of the tools that once softened the blow have already been used. After 2008, central banks slashed interest rates to near zero and kept them there for years. Governments ran massive deficits to stabilize demand. Those measures worked in the narrow sense that they stopped a total collapse. But they also left behind a system addicted to cheap money and permanently higher debt. The comparison with the period after the Great Depression is telling. Following the crash of 1929, private debt in the United States fell by roughly 65% over the next 15 years. That painful reset cleared balance sheets and allowed growth to resume on a healthier foundation. After the financial crisis of 2008, private debt declined by only about 15% over a similar time span. The rest was rolled over, refinanced, or quietly absorbed into higher asset prices. The reckoning was postponed, not resolved. Today, interest rates are no longer pinned at emergency lows, yet debt levels remain historically high. That combination is toxic. Higher rates increase the cost of servicing existing loans, just as growth is slowing. For households, that means more income going toward interest and less toward consumption. For businesses, it means tighter margins and delayed investment. For banks, it means rising credit risk. Recent market commentary has highlighted growing stress in private credit markets, where investors are struggling to assess who ultimately holds the risk as defaults begin to tick upward. This opacity is not reassuring. Asset markets add another layer of fragility. Equity valuations are increasingly concentrated in a handful of large technology firms, many tied to expectations around artificial intelligence. Several analysts have warned that valuations in parts of the technology sector now resemble classic bubble dynamics, with prices driven more by narrative than by sustainable cash flow. When credit conditions tighten, these narratives tend to unravel quickly. Unlike 2008, policymakers today face a credibility problem. Cutting rates aggressively risks reigniting inflation. Expanding deficits further risks political backlash and market skepticism. The margin for error is thin. The uncomfortable truth is that many of the stabilizers that worked last time can now only delay the outcome, not prevent it. When private debt is this high and credit growth this weak, the system does not need a dramatic shock. It needs only time. When economic stress finally breaks through the abstractions of charts and models, it does so in ordinary American lives. It shows up at the kitchen table, not on a central bank balance sheet. For most households, the first pressure point is work. Hours get trimmed before jobs disappear. Bonuses vanish quietly. Temporary contracts are not renewed. In past cycles, these signals arrived late. This time, they are already appearing while markets still project confidence. The reason is simple. When credit slows, businesses lose flexibility. Firms that relied on rolling short-term debt suddenly find that refinancing is more expensive or unavailable. Hiring freezes follow. Layoffs come next. Recent employer surveys indicate that a growing share of large companies are planning workforce reductions heading into 2026, citing weak demand and rising financing costs. This is not a reaction to a crash. It is preparation for one. Households feel the squeeze almost immediately. Credit card balances rise. as wages fail to keep up with essentials. Rent and mortgage payments consume a larger share of income. Medical bills and insurance premiums rise regardless of economic conditions. Data now show increasing delinquency rates on credit cards and auto loans, particularly among lower-income households who exhausted their pandemic-era savings long ago. These are the people least able to absorb shocks, and they are the first to crack when credit tightens. Housing, long treated as an untouchable pillar of American prosperity, becomes a source of anxiety. Higher interest rates freeze transactions. Prices stop rising, then stall. For heavily leveraged homeowners, that stagnation is dangerous. Home equity loans that once felt safe begin to look reckless. For younger Americans locked out of ownership, the promise that patience will be rewarded rings hollow as affordability remains out of reach. What makes this phase especially corrosive is its unevenness. Those with assets, access to capital, or the ability to move money quickly tend to cushion the blow. Everyone else absorbs it directly through lost income and rising costs. The economy does not collapse all at once. It frays. Trust erodes. Households cut back, not because they want to, but because they have to. By the time the downturn is officially recognized, millions of Americans have already been living in it. At this point, the uncomfortable conclusion becomes unavoidable. The real question is no longer whether a major economic break is coming, but how long the system can keep pretending that it is not. Crises are often described as black swans, but history shows they are usually the product of long, visible chains of decisions. Excessive private debt, dependence on continuous credit growth, policy frameworks that assume stability while ignoring fragility. None of this is new. What is new is the scale. The global economy today looks tired. Growth is sluggish, debt is everywhere, and confidence is thinner than headlines suggest. In the United States, households are stretched, businesses are cautious, and policymakers are boxed in by inflation on one side and debt on the other. Recent global outlooks suggest that while headline growth may persist, underlying momentum is weakening, with debt burdens and financial stress acting as persistent drags on future expansion. In other words, the system is moving forward, but against the wind. What makes this especially dangerous is that the costs of adjustment have been deferred for so long that they are now politically and socially explosive. Reducing private debt means slower growth, falling asset prices, and painful restructuring. Avoiding that adjustment means relying on ever more fragile credit expansion until it finally breaks. That is not a dilemma with a painless option. It is a choice between short-term discomfort and long-term instability, and history suggests the latter usually wins. When the next downturn arrives, it will not be evenly distributed. It never is. Those who depend on wages rather than assets will feel it first. Communities already under pressure will absorb the hardest blows. The irony is that by the time the crisis is officially acknowledged, the damage will already have been done quietly, incrementally, and largely out of sight. So this is not a story about panic. It is a story about patterns. The same mistakes repeated across generations, each time under the belief that this time is different. It rarely is. The system does not collapse because of a single shock. It collapses because it becomes too rigid, too leveraged, and too dependent on confidence that cannot be manufactured forever. Thank you for watching, and I'd really like to know what you think about this topic. Do you believe the warnings about a 2026 crash are exaggerated? Or do you see the same cracks forming in the system? Leave your thoughts in the comments below.